today we're going to talk about the accounting for non-current assets. We call it and the depreciation. Okay. Those all of it considered as non-current assets, which means they are assets we are holding for more than 1 year, and those assets are gonna to produce profit for us. Okay. To produce money for us. So all businesses need not only current but also non-current assets, or what we call it in another word, a fixed assets to operate. As explained in our earlier chapters, non-current assets such as land and buildings, machinery, office equipment, furniture and fitting, motor vehicles, etc., are needed to help the business generate profit. Because as example, we have the machine gonna to work and produce for us products. We have the offices furniture, we use it to work and provide our services. So all of this considered as non-current assets. When we first bought the assets, they were recorded at cost price. However, as we use them from time to time, the value of these assets gonna to reduce, because let's say you bought table, you put it 1K, 1,000 ringgit as example. So after like 1 year, if you want to sell it, it's not gonna to give you 1,000 ringgit. Same as when you have a machine, also you have a building because it's already used, and all of this. So all of these things is gonna to reduce the price of it due to the usage of it. So for that reason, we can consider we have to calculate the depreciation. So the reduction in the value of non-current asset is called depreciation. So again, what does depreciation mean? Is a reduction of the non-current asset, the value of the non-current asset. It must be taken into account when we prepare our financial statement. If you see, like, this is the machine. The first year was okay, then a little bit reduce the functionality of it, then the third year is totally done. So depreciation is another adjusting entry. If you remember last classes, we were talking about adjusting entry when we talk about prepaid and accrual, and also when we talk about creating allowance for the doubtful debts. So all of this is, we call it adjusting entries. Also calculating the depreciation is adjusting entry. So for that reason, here we will discuss first the nature of non-current assets, why they are depreciated in the accounts, methods of depreciation and the basis used, how depreciation is recorded in the books of accounts, how they are presented in the financial statements. So let's talk about the difference between capital expenditure and revenue expenditure. Revenue expenditure is expenditure on those items that contribute to the revenue earning capacities of the business, but whose value will only be used within an accounting period. So again, the capital expenditure, the revenue expenditure is the expenditure on those items that contribute to the revenue earning capacity of the business, but those value will only be used within an accounting period. When you want to take example of these things, so that contributes to the revenue earning capacity of the business and charged in an expense account, and at the end of an accounting period, it's deducted from the revenue. Example, we have wages, rental, utility, salary, and advertising expenses. So all of these expenses we can consider as revenue expenditure, which is gonna to be spent within a financial period. One financial period is whether a year or a month, mostly is a year. So this one is gonna to create profit for us. So again, this is what we call it expenses. We call it revenue expenditure. As I mentioned, the revenue expenditure are the expenses which we gonna to do. We pay in one financial period, and it will be producing profit for us. Examples, we have salary, wages, advertising expenses, rental, utility, and so on. Capital expenditure is also expenditure on items that contribute to the revenue earning capacities of the business, but the items are expected to contribute for more than one accounting period. As example, building, sure, we will not end it by end of the financial period and get a new one later. Same land, same machinery, normally they will be used for more than one financial period. The office furniture All of this considered as capital expenditure because those they're gonna to contribute to profit, but it's gonna to produce, gonna to be used for more than one financial period. So this means that capital expenditure is on items of value to the business that don't lose their value within one accounting period. These items of capital expenditure are therefore charged to asset accounts and are termed fixed or non-current assets. So again, we have revenue expenditure, we have capital expenditure. The revenue expenditure are expenses on the assets going to produce profit, but it's going to be utilized within one financial period. Example is utilities, example is salaries, example is rental, and all of this. For the capital expenditure, this is the expenditure which will be contribute to the revenue earning capacities, but for the they will be used for more than one financial period, one accounting period, and they will not lose their value within the accounting period. Example, when you pay for machinery, for land, for furniture, for building, and so on. So this is the difference between capital expenditure and revenue expenditure. About the depreciation. The reduction in the value of non-current asset is a loss to a business. Therefore, this reduction is treated as an expense incurred by the business due to the use of the non-current assets in the business. So the usage of the non-current assets in the business is gonna to create what we call it depreciation or reduction in the asset value. So the failure to calculate the depreciation of non-current assets will result in the value of those assets shown in the statement of financial position as not reflecting the true view. As example, if you, as I mentioned, you already bought furniture 1,000 ringgit, then you need to show it in your financial statement. But if you didn't calculate depreciation, you're gonna to keep showing this asset as 1,000 ringgit entire the life of this asset. So let's say this asset is working for 10 years. So for the entire 10 years, we're going to show this asset as 1,000 ringgit till end of its beneficial life. But at the end of this one, you need to throw this asset and get a new one. Let's say it's a furniture. You need to change that furniture after 10 years because it's not gonna to work more than that. So what you will do that time, you have to get cash from your own pocket and pay for it, or actually for the company pocket and pay for it. So this one is going to put a huge burden on that financial period where you want to change your assets. So for that reason, normally we have to calculate what we call it depreciation to you be able to find or to be able to cover the cost of changing that asset at that time. So as I mentioned, if we didn't calculate the depreciation, so the asset is going to show in the financial position statement not reflecting its true value. In another word, it will overstate the value of the non-current assets. Apart from that, the profit shown in the statement of profit or loss and other comprehensive income doesn't reflect the actual sum, and this will result in overstating the profit. Why overstating the profit? Because as I mentioned, to produce a product, to do the service, you are using that asset. As example, you have a printer. As example, your work is a printing shop. So you have a printer, and this printer is your fixed asset, okay? But you know that printer, its maximum printing, let's say 50,000 pages. So with maybe you need like 3 years to print the 50,000 pages. But after this printing this 50,000 pages, you need to change a lot in that machine, or maybe throw and get a new machine. So if you want to keep considering that this machine is still in the same value from the day you get it till the day you throw it or change it, so like this you are still using, and there is a part of this machine cost should be considered as part of your cost for each financial period. So you have to take that point into consideration when you want to calculate your yearly profit or the profit of each financial period. Revenue recognition, when we add expenditure matched to the revenue received, revenue expenditure equals to the charge of the profit and loss and other comprehensive income the same year minus because the value finished in that accounting period. Salary, sorry, no, this one is not minus. Because the value finished in that accounting period, example, salary and utilities. So if you see here, like the salaries is related to each financial period separated because you know the salaries we pay months or maximum by year. So the salary once is paid is used because normally let's say we pay the salary in end of January. So we already used the service of those people for entire the month. So we already pay for it. Capital expenditure, as example, the building, computer, and machineries, expected to contribute in process of earning revenue for more than one financial period and one accounting period. Therefore, you have to allocate the depreciation of that non-current asset to its useful life. Like as example here, this is a machine. It has 3 years, so we have to divide the value of that machine on these 3 years. Let me give you example about that. Very simple example. Let's say that this machine, this one, it has is 15,000, okay? And the useful life is only 3 years. So we need to divide this 15,000 into the 3 years. So it means each year is 5K. So for the first year, when we pay for it, we will put 15K, we will show in our financial statement. For the second year, we have to deduct 5,000 from our profit as depreciation. So like this machine is going to show in the financial statement as 15K, and under it, we already hold 5K from our income in the previous financial period to keep it to later change this machine. So it will show as 10K. And the second year, again, we hold another 5K. So it will show in the second year 15,000, then minus 10,000 because we have 5K from the first year, then 5K from second year, then it will be 5,000. And the year number 3 we will have nothing. Okay, so this is for year number 2, this is for year number 1. Okay, so this is the things which is normally we have when we are, this is a very short description about the idea of depreciation. So this is the idea of depreciation. So if you see how here we are reflecting depreciation for first year, second year, then third year, then like this, we complete the entire amount of the machinery or the asset itself. So causes of depreciation, why the asset got to be depreciated, there is many causes for it. We have physical deterioration, which is like wear and tear and erosion, erosion, rust, and decay. We have economic factors like obsolescence or inadequacy. We have time factor, for example, leases of a building and amortization of a patent. We have depletion, like expendable nature, as like mines, oil and others. So this is the 4 reasons behind that depreciation. Let's say I'll take an example, the economic factor, or let's say if you buy a software as example, okay, and this software it has like you have a license for 5 years, but within 3 years already this software become very old and you need to update it. Maybe you need to change the entire software because no more is used, so you have to change it. So this is depreciation because this license you bought for 5 years is also, you need to, by end of these 5 years, you need to get a new one. Okay, so this is part of the depreciation, and this is the idea behind depreciation. As I mentioned, there is many reasons behind depreciation of the fixed assets. So here is different based on the type of the asset. The percentage of depreciation mostly is relying on what we call it mostly is relying on the user guide of that machine is showing that how long is useful, how long can be used, and etc. Okay, so this is the idea behind the depreciation, and why do we need to depreciate some of our assets. Okay, so let's go for the methods of depreciation. Depreciation is not following only one way. It has a lot of methods can be used and utilized based on the asset itself. Different asset, it may have different method of depreciation. So normally the depreciation method selected depends on the requirement and policy of, based on the requirement and policy of the business, which is considered appropriate for a certain type of non-current assets. Before calculating the depreciation, we need to know the cost of non-current assets, the useful life of that asset, the estimated residual value or the scrap value or disposal value. So again, before we calculate the depreciation, we have to know these three information. Actually, some of the methods, we don't need to know the scrap value or something like this, but most of the method, this is the main three information we have to look through it, or to look for it. First, the cost of non-current asset, the cost of the asset. Second, the useful life of that asset, for how long this asset will keep useful or generate profit. Third, the value of the scrap, because as example, if you have machinery, if you have furniture, maybe you can sell it as scrap or sell it as disposable value. So the disposal one, maybe you can sell it to some like other factories, or like if it's machinery, so you can sell it as only like metal, so as only metal values. So for that reason, you need to know the estimated value, because also the useful life of the asset is mostly goes as estimation. So that's what we call it, the three main information which you have to know about the asset before you start the asset itself, before you start depreciating the asset. Okay, so we have, as I mentioned, we have the estimated residual value. You need to know the cost of the asset, and you need to know the useful life, or the useful economic life of the asset. Let's take one example about recognizing the about the calculating the cost of the asset. As all of you know, for calculating the cost of the assets, we have some information or some cost, some expenses, which is the price of the asset. Let's say if you want to buy a machine, so they will tell you this machine is 10K, but if we need also to pay another like 500 ringgit for transportation, and then another 200 ringgit for fixing the machine at your place. So these expenses are part of the cost of the machine, because you cannot start using this machine unless and until you pay that cost. So this is, we call it also part of the machine cost. Let's take this example. In the year of the 31st December 2019, Ahmad bought a new non-current asset and made the following payment in the relation to it. So the cost of it is 24K, agreed discount 2,000. So the delivery charges 200, installation charges 400, maintenance charges 600, additional components to increase the capacity for 800, replacement parts 500. So state and justify the cost figure which should be used as the basis for that depreciation. So here you need to calculate the cost of that asset. I want to ask you, can you figure out which of those costs we cannot start using the machine without it? Again, let's say we get the machine in 1st of January 2019. And we want to start use the machine. And this is a list of the costs which we paid entire the year during 2019 for this machine. Can you state for me what are the costs which we cannot start use the machine without it? You can see the list of the costs. So tell me, which one of those costs we cannot use the machine without paying it? Like we have to pay those costs first, then we can start using the machine. Which one of those costs? Installation charge. Okay. Okay, first of all, we have the installation charge. You are correct. What else? Maintenance charge? No, because maintenance normally after we start using the machine, we pay for maintenance. Replacement parts? No, those for maintenance. Also, after we start using the machine, we need to use the replacement parts to do the maintenance. Delivery charge, perfect. Yes, delivery charge. If they didn't deliver the machine, they can't install it. Okay? And sure, the cost of the machine. So yes, as we get from Hafina, we have the delivery charge. As we get from Vixwaran, also Hafina, she said about installation charge. We have the Lavinia, she mentioned about the maintenance. So as you mentioned, we have these three costs: delivery charge, the cost of the item itself, the installation charge, and delivery charge. Those three charges are part of the cost of the asset. Also, there is one of the charges here, which is additional component to increase the capacity. This one also we will consider it as part of this asset cost because this is increasing the quality of the asset. So let's say if we do some components to the asset as kind of maintenance only, so it's keeping its capacity as it is, or is keeping and also keeping the time, the useful time as it is. It's keeping everything as it is. So this one considered as a maintenance. We don't care about it. We don't add as cost for the asset. But if we add some components to the asset, it's increasing its quality, increasing its capacity. As example, if the machine is printing 10,000 pages per hour, and we add one item to it or one component to this machine. So now we start printing 15,000 pages per hour. So this component, we can consider it part of this machine cost because it increased the capacity of that machine. So in our example here, if you want to calculate, as you mentioned, state and justify the cost figure, which will be used to calculate the depreciation. So yes, is the cost of the machine, the 22K, which is the cost per supplier minus a discount, added to it the delivery, added to it the installation, added to it the component which going to help to increase the capacity of the machine. So the amount to be capitalized and depreciated should be based on all the costs of bringing the asset into use, excluding any cost incurred through actually using it. Since the additional component increasing the productivity capacity, they should be treated as part of the asset's capital cost. Some accounts refer to such expenditure as improvements. So maintenance cost, replacement parts are clearly cost of using the assets, are not the historical cost of the asset. So I should be treated as expenses charged to the profit of that financial period. The cost used as a basis for depreciation should therefore be based on the purchase price, 22K, plus delivery, installation, and additional component. And yes, so therefore it's like 20K, the delivery, installation, and the additional component. So it's 23,400. This is the cost which we're gonna to consider for depreciating. Okay. So as we mentioned, to calculate the depreciation, we have three information we have to know. Some of this information may be different between one or to another method, but in general, those are the main methods we have to use. First method is first information we have to know the cost of the asset, which we need to depreciate. Second one, we need to know the useful value of that asset. Third one, we need to know the scrap value, which means how much we're gonna to sell this asset at the end of its useful life. Mostly, I want to give you here one important information. For the scrap value and the useful life, mostly it will be estimation. As example, they will tell you that this machine is gonna to be useful for only 50K printing. But then you can print 60 and 70K with same quality. So as I mentioned, mostly is estimation. Like, okay, like as a table, they will tell you can like estimate that I can use this furniture only for 5 years. But if you really give a good care for that asset, maybe you can use it for 7 years, 8 years. So mostly the useful life plus the residual value are to be estimated. Mostly are estimated numbers. We try to estimate those values to calculate our depreciation. Okay. So any question about calculating the value which we need to depreciate? Other two costs, no, we don't include for the other two costs, we don't include here to calculate the things. The other two costs we have here are for the usage, okay? So for that reason, they are not added here to calculate the cost which we need to depreciate, okay? So now let's go for the methods of the depreciation. We have three main methods for depreciation, which is straight line, or we call it fixed installment method, reducing, or we call it dimensioning or declining balance method, units of production method. So we have three methods for depreciation. We need to keep it in our mind. And normally you will be in the questions, if in case you get this question in the final exam, you will be asked that what you will be informed to use one of those methods. So we have three main methods, which is a straight line, or we call it like fixed installment. Second one is reducing or dimensioning or declining method. Third one is units of production method. Straight line method is very easy. It's as you see the example which I showed before, like 15K, the price of the machine, we divide for its useful value, which is 3 years, and like this, but we need to reduce its scrap value. So straight line method, this method is known by various other names like fixed installment method, flat rate method, or on cost method. So any of those four names like straight line method, fixed installment method, flat rate method, on cost method, any of those you can use for any one of these you can use for explaining or for same meaning. Okay, those four words like straight line, fixed installment, flat rate, on cost method, those four names has same meaning for that same depreciation method. Let's start with the straight line method, which is we mentioned has a lot of names. Under this method, a fixed rate on original cost of the non-current asset is depreciated every year until the end of the asset's useful life. This means the reduction in the value of the asset each year reflects a ratio in the original cost. For instance, if an asset has an estimated useful life of 10 years, no scrap value, it means you have to divide the cost of that asset on 10 or multiply it by 10% for each year. Let's take example. So the basic formula when you want to calculate the depreciation is the original cost. Like sure, you need to consider if you have installation cost, you have transferring cost, minus the scrap value. You need to consider the scrap value here, which is the value of the asset in the end of its life if you want to sell it as scrap, divided on number of expected years of use. Let's take this example. Abu, he's a businessman. He bought a machine costing 48K, and the machine is expected to be used for 10 years. At the end of the 10th year, the machine is expected to be sold as scrap metal for 1,000. So the cost of that machine is 48,000. The scrap value is 1,000 and it will be used for 10 years. So to calculate the depreciation based on the straight line method, you need to put 48K minus 1,000 divided on 10 years. So each year you need to put depreciation 47,000. Okay, so this is one of the easiest method to calculate the depreciation, which is the straight line, which means you have to take the cost of the asset minus the scrap value of the asset divided on the number of years, the useful life of that asset. Or you can get the depreciation as percentage. Example, Pusu buys a new motor vehicle, which is 100K, and it has been decided that the vehicle to be depreciated rate of 10% per annum on cost. So if you didn't get information that there is a scrap value, it means no scrap value at the end of the life of this asset. So annual depreciation is 10% of the original cost. So it's 10,000. End of 10 years, you will see that depreciation amount is equal to the cost amount of that value because we have no scrap value. So the straight line method is the easiest, most straightforward method for calculating the depreciation. So the first method, as we mentioned, is the straight line method, which is you take the cost, you deduct from it the scrap, and you divide it on the number of the years will be used. Or if it's percentage, also you take the cost, you deduct from it the scrap, then you multiply based on the percentage. Okay, this is how you calculate the depreciation. So let's go to the second method, which is reducing balance method. This method is also referred as dimensioning or declining balance method. This method, I do believe that the asset it will give more profit or more capacity or more production in the first few years of its life, which going to be dimensioned or like reduced by the by years. Okay, so this is a belief of this method that the asset is going the useful life of the asset or the production of the asset, not useful life, sorry, the production of the asset is going to be dimensioning by years of its usage. Okay, so for that reason they try to deduct bigger amount in the first few years of the life of the asset, then reduce the amount based on the usage of based on year by year. So under this method, in each period a fixed percentage rate is charged on the reducing value of the asset. This is a carrying value, which means at the beginning of an accounting period, carrying value was previously known as net book value. In short, the carrying value of an asset is the original cost of the non-current asset minus accumulated depreciation. What does it mean? Let's say for year number 1, the cost of the asset is 10,000. We decided to calculate depreciation 100, okay? We decided to calculate depreciation as 100, which means the carrying value for first year is 10,000 minus 100, which is 9,900. For year number 2, also now the carrying value is 9,900. We also want to calculate, let's say 100 ringgit as depreciation. So the carrying value for next year, it will be 9,900 minus 900, which will be 9,800. Or in another word, is 10,000 minus the accumulated depreciation, which is 200, which will equal also to 9,800. This is what we call it, the carrying value. Okay? So the carrying value, as I explained, is the original cost of the non-current assets minus the accumulated depreciation. So the percentage rate used depends on the types of non-current assets. Some non-current assets may depreciate faster in the early years and require a higher rate of depreciation. As example, a personal computer which becomes obsolete rapidly. Other non-current assets may require a lower rate of depreciation. One example is furniture, which will still be good shape even after years of use. So you may recall that depreciation is merely an estimate of the cost of using the non-current asset to generate profits. As such, the rate charged can never be accurate and very often based on the rule of thumb. Let's take example about reducing balance method. A machine is bought in 20K and depreciation is estimated at 20% per annum on a reducing balance. You notice there we already mentioned what is the method we're going to use is reducing balance. You are required to calculate for the next 5 years the annual depreciation charges, the net book value, and the estimated scrap value. By the way, when we are having reducing balance method, we don't take scrap value, which means for the we will not be given the scrap value in the beginning. Okay, it will be there will not be given a scrap value. The end balance after we finish using this asset, it will be the scrap value. It's different than the straight line method, which is we need to get the cost, then the scrap value, then now number of years we need to use is different. For the reducing balance, we will not get a scrap value in the beginning because the scrap value will be the result at the end of the usage of how much the balance left at the end of the usage of the asset. So this one is 20,000. For first year is 20%. 20% of the 20,000 is how much? Is 4,000. So the carrying value, it will be 20,000 minus 4,000, it will be 16,000. Then this is year number 1. Year number 2, it will be 16,000 multiplied by 20%. So it will be 3,200, that depreciation. So the carrying value, it will be 16,000 minus 3,200. It will be 12,800. And like this, we continue for year number 3, 4, and 5. Let's see. For year number 1, the cost of the machine is 20,000. The 20% of it is 4,000. So the carrying value is 16,000. Then the year number 2, we need to take the depreciation, which is 20% from the carrying value. Okay, this is, we call it carrying value, which is the value we want to carry from year to another. So also 3,200, the balance is 12,200, 12,800. Third year, we calculate 20% also from the carrying value. So again, it's 2,560, then the balance will be 10K, 240. The year number 4, also 20% of it, the balance will be 8,000. The year number 5, it will be like this. So the leftover at the end of this machine life, it will be the scrap value. Okay? So this is the reducing balance. As you see how we are calculating it, we are calculating for each year a percentage. Okay? So this percentage is from the leftover amount. So as I was explaining here, another example we have, which is about the reducing balance method. It's same as our previous example. You need to deduct the percentages. You need to take the cost, deduct from it the accumulated depreciation, then you multiply the percentage. So, okay. Let's continue with the third depreciation method. The third depreciation method is about the units of production method. This method will deduct the cost, or that will divide the cost of that asset based on how many units it's producing. Okay, so based on the units being produced, therefore the useful economic life of the fixed asset is estimated based on the total production unit. Let's take what is the equation. You put total units that can be produced per year divided on the total units can be produced throughout the useful life of the asset, multiplied by cost minus scrap. As example, if the cost is 10,000, scrap is 0. Okay, the total units can be produced this year 100. The total units can produce in the total life of this asset is 1,000. So when you put 100 divided on 1,000 multiplied by 10,000. Let's take example. So here, if based on the product units we produce, here if we based on the hours, because some machine based on the hours of using. You see, like as example, like laser machine based on how many click you can press. So they tell you this machine has 20,000 clicks. So also you need to say, okay, how many clicks I used this year, divided on the 20,000 clicks, multiplied by the cost minus the scrap. Let's take this example. A machine is bought for 20,000, can be used for 50,000 hours. So the cost is 20,000. The number of hours for throughout the life of the machine is 50,000 hours. The estimated that there will be no scrap value at the end of the life. It assumes the usage of the machine per the hours we use per year is like this: 18,000, 12,000, 10,000, 18,000, 2,000 for each year. So here we need to calculate the depreciation of each one of it. If we go to the previous equation, if you see, total hours that can be used per year. So let's see, year number 1 is 18,000 divided on the total hours for entire the life of the asset, which is 50,000. And this one will be multiplied by the cost of the asset minus scrap. There is no scrap, so multiply by 50,000. Second year, it's 12,000. This is the number of hours we can use this year, divided on the 50,000, the total hours for entire the life of the asset, multiply by 50,000. Oh, sorry, this is a cost. Yeah, it's my mistake. Yeah, it should be multiplied by the cost of the asset minus the scrap. So the cost of the asset is 20,000. Third year, same story, 10,000 divided on 50,000 hours, multiplied by 20,000, the cost of the assets, and so on. So let's see how the calculation will be. 18,000 divided on 50,000 multiplied by 20,000. This is a depreciation for each of the years. Okay, so if you see that how the cost is being divided based on the how many hours we are using this machine per year. So if you notice here, we get 3 methods of depreciation: straight line, reducing method, and the third one, which is a units of production method. Those 3 methods can be used for calculating the depreciation of the fixed asset. So for depreciation, if you remember the previous 3 ways we have learned, or 3 methods for calculating depreciation, we were considering that whenever we have hold the asset, we are calculating the depreciation for it, which means, let's say we hold the asset we bought the asset in February, or we bought the asset in December. In both ways, when we are calculating, let's say the straight line method, and we say it's 10%. So we are just multiplying the cost of the asset with 10%, and then we are getting the depreciation amount. Also, for the reduction method, let's say that we are calculating the first year. Again, we are taking, let's say that the first year is 10%, so it was like 10,000 ringgit, the cost of the asset. We multiply by 10%, so we will take the amount as depreciation. Then second year, we are deducting the previous depreciation and then calculating the depreciation based on the percentage. Here, in that methods we were learning, we were not considering that when we hold the asset, when did we buy the asset, whether we bought the asset in the beginning of the year, mid of the year, end of the year, beginning of the month, end of the month. We were just calculating that percentage without consideration of that. So let's now move a little bit more into the details of this issue about when we hold the asset. So end of year paces, or we call it the yearly paces, here we ignore the dates during the year when the assets were bought or sold. We merely calculate the full period depreciation on the asset and use at the end of the period. This is what we were following, okay? We ignoring when did we get the asset. So thus, assets sold during the accounting period will have had no provision for depreciation made for that last period, irrespective of how many months they were in use. So with the yearly paces or end of year paces, we are just considering what are the assets we are having end of the year, and we are considering that we use the asset for entire the year. We don't care when this asset being bought or for how long it was being under usage. So conversely, assets bought during the period will have a full period of depreciation provision calculated, even though they may not have been used throughout the whole of the period. So this is what we call it the yearly paces depreciation, which is relying on the year-to-year paces and end of year paces, which is relying totally on what are the assets we have end of the financial period. We have another basis, we call it monthly basis or month-to-month basis. So here we are considering how many months we are holding that asset during the financial period. So here the provision for depreciation is made on the basis of 1 month's ownership, 1 month's provision for depreciation. A fraction of a month is usually ignored. However, some may consider it as 1 month ownership if they have possessed the asset for more than or equal to 15 days. This is clearly a more scientific basis than the end of year basis mentioned above. So when we are talking about the difference between year to year and month to month, when we are talking about year to year, sorry, just 1 minute. Okay, when we are talking about year-to-year basis, it means if we bought the asset January, it will be same if we bought the asset in December. In both way, we're gonna just to calculate the depreciation for the whole year. But in month-to-month basis, if you bought the asset in January, it's different if you bought the asset in February. It's different if you bought the just I don't know why it's writing like this. Okay. So when we are talking about year-to-year basis, if you bought the asset in January or if you bought it in December, it's same. But when we are talking about month-to-month basis, if you bought the asset in January, it's not similar if you bought the asset in February. It's not similar if you bought the asset in March or any another months. For each of these differences, we're gonna to consider how many months we are holding the asset. Also, when we are in year-to-year basis, if we sold the asset during the financial period, so no depreciation will be calculated. But in month-to-month basis, let's say we sold the asset in March. Okay, so we're gonna to calculate depreciation for the time we were holding the asset from the beginning of the year till the selling date. So this is the difference between the month-to-month and year-to-year, and month-to-month is mostly more accurate somehow and more close to the reality, because in the year-to-year, as example, year-to-year basis, we may sell the asset in December. which means we have used this asset for entire year, but in the end of the financial period, we don't have that asset. But so on a year-to-year basis, if we don't have the asset end of the financial period, we don't calculate depreciation for it. While in month to month, as I mentioned, whenever we sell the asset, we have to calculate the depreciation for entire the usage period. So that's what we have to take into consideration when we are calculating month to month or year to year basis. So as I mentioned, for the depreciation, we have two bases. We have year to year and we have month to month when we are calculating year to year. So we calculate the depreciation for entire year without taking into consideration how many months we hold the asset. Also, when we sell the asset by end of the financial period, before the end of the financial period, so we are not going to calculate the depreciation for that asset. It's totally different than the month-to-month basis, because month-to-month basis is relying on calculating the depreciation based on how many months we are holding that asset. So even though we sell the asset before the end of the financial period, we still have to calculate the depreciation for it for the time you were holding this asset. Also, we for the month-to-month basis, here some is based on the companies. So some companies, they will consider whenever is in the month will be full month. Some companies, they say no, 15 days and more. If this is less than 15 days, so it's not be considered. So now we will have some one example going to explain to you what do I mean with that. This is an example. A business started operating in 2013. The following transaction refer to non-current assets in 2013. So those are the non-current assets the company holding in 2013. Okay. And February 3rd. So here, when we are taking here we are just giving you the date when we have hold the asset for the more calculation. So February 3rd, we purchased motor van WMG 1012 for 100,000. So this is the cost, okay? And this is the assets. March 25th, we purchased furniture amount of 25,000. August 7, we purchased fixture and fitting cost 35,000. September 10, we purchased equipment to the value of 60,000. The business policy was to charge depreciation of all non-current assets at 10% per annum using straight line method, okay? But on a month-to-month basis. Okay, so you need to keep this information. How much we have? We have 10%. We are using the straight line method, but it's not year to year, it's month-to-month basis. For your information, if you have been told that this asset, we need to calculate depreciation based on straight line method, and we didn't mention if it's year to year or month to month, so you have to take it as yearly basis, which is year to year. But in case you have been informed that is month to month, so you will calculate month to month, okay? So the default way is to calculate year to year basis. Once you have been given a question, as no mentioning whether it's year to year or month to month, so you have to calculate as year to year basis, as yearly basis. But if you have given based on the question and written is month to month basis, so yes, you have to calculate as monthly basis. So here our question, we have the days, we have the assets, we have the cost. Our method is a straight line method, and we are using month-to-month basis, and our percentage is 10%. Also, extra information they mentioned, it was also the policy that any non-current asset owned for less than 15 days was considered not owned during that month. So you are required to calculate the depreciation charge for the year 2013. Okay, so my question, let's first think or calculate how many months we are holding each one of those assets. Let's go to the first asset. The first asset we have February 3rd. So how many months till end of this year we are holding these assets? Who can tell me? We bought the first asset in February 3rd. Can you calculate how many months we own that asset? That's correct. We are holding that asset for 11 months. Okay? Because February will be counted as one of the months because we hold it 3rd of February. So, second asset, how many months? We bought it 25th March. You decide 10 or 9 or what? Keep in your mind any asset hold for less than 15 days in the month, so not considered hold at that month. So, okay. So, our asset has been held in March, 25th of March, so March is not counted. So we have April, May, June, July, August, September, October, November, and December. So our 9 months as fixed warrant answer as the first correct answer. So here we have 9 months. Asset number 4, how many months? Sorry, asset 3. Asset 3, 5 months. Okay, August, September, October, November, and December. Yes, is 5 months. Then the last one? Yes, is 4 months. That's correct. Okay, so yes, this one is 4 months. So like this, we calculate how many months we are holding each one of those assets. So let's go to see how the calculation will be. So for the first asset, we said we hold it for 11 months. So the normal way, if we want to go as a normal straight line, so what we do, we multiply the cost of the asset with the percentage of the depreciation. This is the normal straight line. This is a year-to-year basis. But if we are taking month-to-month basis, we have also to multiply with the number of months held. So 11 months divided on 12, which means we are taking this depreciation, we are dividing it in 12 months, and we are just taking only 11 months of that amount because we own that asset, or we hold that asset, or we use that asset only for 11 months. Furniture, if you remember, we calculate 9 months. Fixture, 5 months we used. Equipment, 4 months we used. So this is how we calculate the straight line method, but month to month. Okay? So again, what we do the normal straight line, which is the cost multiplied by the percentage, the depreciation percentage. Then we need to add this part, which is how many months we are using that asset. This is the difference between year to year and month to month for straight line method. So if you were told instead that the business policy was to charge depreciation on the end of year basis, then the calculation would be simplified as for each one of those assets, you just take 10%, then you will calculate that difference. If you see, when we took month to month, our depreciation amount was only 15,500. But when we take it on a year base, the total depreciation becomes 22,000. The difference here, because for the first asset, here we use 12 months, but here we use only 11 months. For this one, we depreciate for 12 months also. But in the month-to-month basis, we depreciate for 9 months only. So the amount we hold is less. Again, here also the amount we hold is less. Also here, the amount we hold is less. So for that reason, the total amount is totally less than the one which is this. Actually, this one is as year-to-year basis, when month-to-month is 14,500. This is month-to-month basis. You see how much difference between two numbers when we are taking year to year or month to month. So you will ask me, okay, so which one we should take here? It depends on the company, what they like to decide. Actually, month to month is more accurate, but it's more complicated to calculate. So for that reason, it's a company decision to decide which one need to follow. Let's take the same example, but we use different depreciation method, okay? A business started operating in 2013. Information with respect to non-current asset in 2013 is the same as example 8. The following transactions were recorded in 2014 and 15. So here what we are saying, we have in 2013 similar number of similar assets here, and we get another assets in the year 2014 and year 2015. So this is the assets which we have. We bought and we sell. We sell some assets in 2014 and we bought some other assets in 2014. We sold one asset in 2015. The question, you are required to calculate depreciation charges for 2013, 14, and 15 at 10% per annum using reduction balance method on a month-to-month basis. Okay? So we are having similar things of the previous month, the previous example, same assets here, which we bought in February, March, April, August, and September. This is for 2013. For year 2014, we have some buy and sell. For year 2015, we have selling asset. So what you are required to calculate depreciation, percentage is 10% per annum. The method is reducing balance method, and is month-to-month basis. So ownership of less than 15 days in any given month is considered not owned during the month. So let's calculate first for 2013. In the previous example, we used the straight line method, but here we want to use to the same numbers, but the reducing balance method. So if you remember the first asset, this is in 2000. Okay, for 2013, when we are calculating using the reducing balance method, the numbers will be similar to the one when we are using straight line method because we don't have previous depreciation to deduct. Okay, so for that reason, it will be similar amount for both ways, that the straight line or the reducing balance method. It will be similar amount. Why? Because if you remember the difference between reducing balance method and the straight line method, that we need to reduce the previous depreciation, or what we can call it, we need to use the carried values. Okay. So for the first year, as we bought those assets as a first year, we don't have carry value. We don't have we don't have like carried value from previous year, like 2012. We don't have previous depreciation. So calculation for that depreciation in both ways, reduction balance method or the straight line method, it will be similar. Let's go to year 2014. So when year 2014, we need to calculate the depreciation of the previous assets we own and the new ones we bought. So first, let's go with the first asset, the WMG 012. If you go to B4, this asset, we bought it 3rd February 2013, and the cost was 100,000, okay? In year 2013, we calculate the depreciation. Depreciation was 9,000 and 167, okay? This is depreciation charges for this asset. So the carried value, because we are using here the reduction method, the carried value is 100,000 minus 9,167. So 100,000 minus 9,167 multiplied by 10%. How many months we are holding this asset? If you notice here in year 2014, we sold that asset in 2nd of March, which means we only hold this asset for 2 months, January and February. So for this year, the year 2014, we need to calculate that depreciation for only 2 months. So here is the carried value, and here is the percentage of the depreciation, and here is how many months we are holding that asset. So the depreciation will be this amount. We go to the furniture. Furniture, if you remember, we bought at 25,000. The first year depreciation as we calculated here was 1,875 based on the month's basis. In year 2014, we didn't sell that furniture, which means we're gonna to calculate depreciation for entire the year of 2014. So we put 12 divide on 12. So it's same as like yearly basis here because we are holding this asset for the full year. So this is what will be our depreciation charges for that year. The third, we have the fixture and fitting. Again, if you remember, so here are the previous assets we are having from previous year. Then we will think about the new assets, okay? So this one we already sell. Then the furniture we already calculate. The fixture and fitting, when we put it 35,000. The carried value is 35,000 minus the previous depreciation, which is 1,458. And we didn't sell this furniture here, which means we're keeping this fixture and fitting for the year 2014. So it's 35,000 minus the previous depreciation here, which will be the carried value, multiply by 10%, multiply by 12, divide on 12. Like here also you can put or you don't put, is up to you, okay? Which is equal to 1. So like this, the amount is 3,354. The equipment, same equipment which we have bought in the previous year. We bought at 60,000. Then the depreciation we calculated previous year was 2,000. The carried value is 60,000 minus 2,000. We use this asset for the full year. Depreciation is 10%. Then we calculate it. Now we come to the assets which we have bought in 2014. So this one which we sell, we already counted. We bought a motor car number WNNT452 in April 9. So here, how many months we are holding this asset? First of all, this asset we don't have it previously, which means we don't have carried value. We'll use the cost itself. How many months we are holding this asset? So April will be counted. So we have April, May, June, July, August, September, October, November, and December, which means 9 months. So for this car, we take the cost. There is no carried value because we don't have this car earlier. So we are not taking into consideration a carried value. We just take the cost, multiply by 10%, multiply by 9, divide on 12, which is how many months we have used this asset. Similar for WNQ8823, we have also, we bought it 4th of June, and this is the amount. No current value, we will use the cost itself. How many months? June, we bought it 24th of June. It means June is not counted because we said less than 15 days per month. The month is not counted. So we go directly to July. July, August, September, October, November, and December, which means we have 6 months. So the cost multiplied by percentage of the depreciation, multiplied by how many months we use the asset. This is the amount. Then also we have a new equipment. We have bought it in July 4. Also, we don't have this equipment earlier. It means no carrying value. We only use the cost of that asset. So we bought it July 4. For how many months we use? July, August, September, October, November, and December, which means also 6 months. So we calculate the depreciation based on that. You can notice that we bought the asset 24th of June or 4th of July, keep as taking 6 months. Because the policy of this company, when you hold the asset for less than 15 days of the month, so the months will not be counted. So this is a depreciation in the year 2014. When we want to go to year 2015, so here they are showing you what we calculate. We go to year 2015. Again, if you see the previous table, somehow we do similar. We add for it the one which we bought in this year, or we sell. So WMG, we already sell it year 2014. It means year 2015 we don't have. It's already disposed in 2014. The furniture, The carried value is the 23,125 minus the previous depreciation, which is 25,000 minus 1875 minus 2313 multiplied by 10%. For the furniture also, we're having it for the full year in year 2015 because we didn't sell it. Again, we calculate. The only asset which we have sold in year 2015 was the WNN. We sell this asset, if you see here, this asset we have sold in May 23rd, which means we own for entire May. So we have January, February, March, April, and May. We already used for 5 months. So this asset got to be counted for 5 months. We put the carried value. Then we calculate depreciation, and we calculate the depreciation for the rest of the assets, which we keep holding for entire the year. You need to notice here one point that if you see for the year 2015 and year 2014, we didn't mention about the assets which we keep holding. When we don't mention, it means we keep hold the asset. So you have to calculate depreciation for it. Don't just rely on, okay, we bought those assets, so we calculate depreciation for those, but you didn't sell the previous assets. So also you have to calculate depreciation, because depreciation should be calculated yearly, like each year, whenever we are having the asset. For how long that we are having, let's say we are holding the asset for 10 years, each year we have to calculate depreciation using whatever method we are using, okay? So this is one of examples about how to calculate depreciation, the depreciation for an asset, for non-current asset, using the straight line and using the reduction method in month-to-month basis. Okay. Here also having all the details, how we do the calculation. So here also telling you if the question required was reduction balance method, but end the year, but on the year and year-to-year basis. So you will see we don't have this is like 12 divided on 12 or 6 divided on 12. We will do the normal depreciation as reduction method without considering for how many months we are holding the assets.